Math is fun. Math is awesome, and you need math to trade. Trading is math. Those are our lessons today, and it's going to be a lot of fun learning about them. The man who can teach us all those things is here. His name is Steve Burns. Let's talk with him. Let's do it right now. Steve, it's great to have you here. And I have to know, like, most people think math is not sexy. But when I read your stuff and listen to you, I think, okay, he's got my attention. And your thing is like trading is like math. So can you just lay it on me? Like where do we start? I don't even know where to start from here. How is trading like math?
It's interesting how that all started. I tweeted out one time, I said, trading is not predictions and opinions. Trading is math. And I tweeted that. And then I had people start, messaging me on Instagram and Twitter going, saying, what do you mean trading is math?
Exactly.
So I thought, okay. I mean, in my mind, it's always natural, risk reward ratios, moving averages, positive expectancy.
Right.
I always thought, how big your wins are, how many losses you have in a row, compounding interest, all the stuff. I thought, that's very simple in my mind. It all makes sense, but people are saying, what the heck do you mean? So
right.
I had a private message. I explained all the different mathematical dynamics, and then I thought, this is a really good reply. And I thought, I'm going to share this on social media. And I shared it across all my social media platforms, and it was one of the most viral things this year. It just went nuts.
Who knew?
Replies.
People love math. I wouldn't have guessed.
Who would have? I could never. The title, like trading is math, that's my title of my post, and it went nuts. And I've been trying to explain this for 15 years. And like you said, nobody ever cared. So
if you said, hey, have you seen my viral math trading post? I would be like, no, does such a thing exist? And apparently it does. So, all right, you tell me where we begin. Obviously, when you're trading securities, right, there are prices, there are numbers and ratios and math everywhere. But when you just say trading is math, there's something that upsets the visceral balance of things, because people think trading is about discipline. People who know. They'll say it's about the discipline. And of course, you have to know the math of risk controls and position sizing and so forth. But that discipline is the sort of, inhuman, weird thing that you must consistently do. You're not singing that song. I would guess you agree, but that's not the song you're singing. The song you're singing is trading is math. What are you trying to tell us?
Yeah, I believe, you are correct, but, the discipline of actually following any kind of a trading or investing system could come from the math itself. If you understand the math of the expectancy of your system, strategy, or investment portfolio long-term, it will help with the discipline.
I see. Got it. Right. That's what the discipline is about. Okay. So with other folks, and we've talked to a lot of people on here, man. I've been doing this since 2018. So it's like, once a week since 2018, just dozens and dozens and dozens of market wizards and other like really great traders. We all arrive at the same place, which I just said, the risk controls. They'll eventually, one of them, I forget who it was recently, who said, Dan, I could almost pick trades randomly. I could randomly take the trade and just use my risk control and position sizing, and then, do that 10 times and probably still get a decent result. That's how important that is. I'm assuming this math you're talking about has a lot to do with that. Is that a good guess?
Very good guess. Sounds like you're talking about Tom Basso and the late Van Tharp wrote a paper about the random entry strategy, where they simply use risk reward ratios, stop losses, and trailing stops to make money randomly by using the math of the positive expectancy.
Yeah, we knew Van well, actually, around here. He was a friend of the firm for years. But I wasn't specifically talking about them. I'm talking about somebody we interviewed recently. I'll remember it. I'm like 64 now. The memory doesn't work the way it used to. But we need to inform our listener on this. We need to tell them what is what. What is Steve talking about? And let's break it up. Like, what is the first thing as a trader that if you're telling me, look, trading is math because, and this is the first thing, what's the first thing that I should know?
The first thing that applies to everybody from day traders to Warren Buffett value investors is the risk to reward ratio. I think that's first step. And that's the variance of your stop loss placement versus your profit target to start with. I think if you can get a 2-to-1 reward to risk ratio as your first step in whatever trading or investing style you do, I think that's the very first step that you can have a positive expectancy over a series of trades or investments.
Right. So you want something that you think your expectation is that it'll go up 2 or more times more than the stop loss you're willing to put in, right? So if you're buying something at 10 and you think it's going to go to 12, your stop is at 9.
That's the very first step. Of course, trend followers want to have a 10-to-1 or a 5-to-1. It's all different, but that's the first step.
I was going to ask because that is what I normally hear, like 3-to-1, 10-to-1, 5-to-1. Nobody's ever bottomed it out at 2.
Yeah, yeah, but I mean, some day traders would do that because of the smaller intraday time frame. But if you get a 50% win rate with a 2-for-1 reward to risk ratio, that's profitable, regardless. I mean, that's the very first basic step of math.
I'm glad you said that, Steve. I want the listener to understand what Steve just said. If you're losing half the time, but you're managing the risk reward right, you can still make money. And I'm glad this came up because I think a lot of the times, we have a lot of individual subscribers in our newsletter business and individual investor readers. They're not like institutions, they're just individuals managing their own accounts. And I remember as an individual, when I started out, I had this naive viewpoint that there has to be something these people are doing that just wins every time, right? It just wins every time, right? I just all I want to do is double my money every time. I remember specifically a couple I met during the dot-com boom who said, no, we didn't do this or this or this because we didn't want to make 50%. We wanted to make 100%. I thought, well, okay. But the reality is if you can be right half the time, you're pretty damn good, right?
Oh yeah, and that's proven across you. You know that from your years of the professional traders. Most great traders are right about 50% of the time. It's just the size of their wins that offsets their losses. And no new traders or new investors want to accept that. They want, like you said, 100% win rates. How can I double my money quickly? It's crazy how they start their mindset.
Right. So I guess the first lesson here is what you said about the 2-to-1 risk reward at least, and understanding that like this is, you can immediately see why discipline is important, because you have to reiterate. You have to reiterate and reiterate and reiterate and trade and trade and trade to generate the returns, right? There's no, I'm going to double my money every time. There is, I'm going to do risk and reward right every time with great discipline. And then over time, if you do it right, you win. And even that, maybe you have a losing year every now and then, right?
Yeah, that's another thing people can't stand to know that professional traders have losing weeks, losing months, or even losing years. I mean, that's what baffles their mind. How can you be a professional trader and have a losing year? I think it's impossible.
Right. It's crazy. It sounds crazy. I thought you knew what you were doing. So, let's lean into that. If you know what you're doing and you have losing months, or a losing month or 2 or 3, or a losing year, is there a specific reaction to that? Is there an action to take, or do you simply accept that as a part of your system?
Yeah, I think it's the expectancy. If you have back tested your strategy, like if you're let's say you're a buy and hold S&P 500 investor, one of the safest things, you're buy and hold S&P 500. You can expect a 50% drawdown about every 7 to 10 years. You can expect that. That's not going to be different, and you can expect about 12 to 15% annual returns on average on S&P 500 buy and hold. And I think every trading and investing system is like that, where you have to have the expectancy of whatever your system is, your drawdown, which comes to the position sizing and how much you're going to lose per trade. If you're risking about 1% of your capital, if you lose on a trade, and you have about 50% win rate, you're going to have 10. You could have 10 losing trades in a row and be down 10%. Now that's math, and when you do what you like, you don't freak out. I expect to have once or twice a year 10 losing trades in a row, and the market environment changes. So
Right.
I think understanding the expectancy helps deal with the losses and drawdowns and losing streaks.
What my experience has been in this business is that And even personally, I haven't been perfect. I've blown myself up a few times in the last 30 years. I mean, not for many years now, but it happened. And the thing is, you come to a place, don't you, Steve, where you really better know yourself extremely well, because what you're doing is you're projecting forward in time your whole emotional and mental state when you're looking at a 20% drawdown or something. And you're saying, oh no, it's in the system, I'll be okay. And then you get there and you do everything wrong because you just don't know yourself and you really don't have the discipline. I mean, if somebody's really determined and you know that they maybe don't have the experience, what in the world do you tell them? You know what
Yeah.
I'm saying? I mean,
Yeah, I mean that's the thing. You have to go into it understanding the risk, and part of the math on that too is if you get a 10 I try to keep my drawdown. Same thing with you. I've had 50% drawdowns multiple times, and been through those journeys. It learned risk management through those.
yeah.
But I prefer now 5 or 10% drawdown. So if you get a 10% drawdown, the math says you need about 11% to get back to even. But if you get a 20% drawdown, you need 25% to get back to even. And then
Mm-hmm.
you get to 50% drawdown, you have to double your capital to get back to even. That math needs to inspire you to not have those drawdowns
Yeah.
because, whatever you're going for in returns, you're going to face the same uh, reverse polarity in losses. So it's good to really, like you said, taper your gains and your losses to what you can mentally endure. And like you said, it's going to be a lot less than you think you can, especially with how big your capital is. Going into a 20% drawdown with multiple six figures is a lot different than going into a 20% drawdown with, maybe five figures. So you need to understand that. And math can help you understand the math of the drawdowns and the recovery time.
Right. Yeah. No, what you just said is something I was told years and years and years ago. You cut your money in half, you got to double it just to break even, right? And of course, I didn't appreciate it. And then it happened to me, and I thought, oh my God, I never, ever, ever want to do this again. And I was lucky that it happened when I was younger. And making those losses when you're younger, man, I highly recommend it, because you're gonna make them. And you better make it when you have a lot less money and a lot more runway ahead of you, to recover and learn and grow your capital. A lot of folks, though, we, like I said, we have all individual and primarily overwhelmingly individual investors as listeners and readers and stuff. And we as a firm have been sort of obsessed, with sticking to your stops, don't oversize the position, et cetera, et cetera. Those are the really two big ones, aren't they? Is there anything bigger? Like, I always come back to that. Is there anything bigger than the honoring the stop and sizing the position right?
Yeah, I like to measure total capital loss per trade to understand your potential risk and risk of ruin and drawdown. So, like,
Okay.
what percentage of your capital, if your stop loss is hit based on your position sizing, how much of your capital do you think you're going to lose? And I, really advise people to stay within 1% of 2% of capital loss if your stop loss is hit. So if you have, like I said, you have 10 losing trades in a row, losing 1% per trade, you're going to be down 10%. If you're risking 2% of your capital and lose 10 trades, where you're going to be down 20%. So
Right.
I like to think in terms of capital of risk per trade.
Right. And for you personally, is there a strict single position size, or do you size it for the trade, or how do you establish size, and what's your preferred size?
Yeah, in general, for my trading account, a more aggressive taxable trading account, I do about 10% position sizes. So even if the stock goes down 10%, then it's a 1% loss.
Hmm.
But I can go. But in my bigger, more aggressive capital that's tax deferred in my retirement accounts, I'll go 20% in indexes. I like trading indexes or
Okay.
even leverage indexes sometimes with 20% position sizes. So even if it goes against me 5%, I'm still only down 1% of capital.
Yeah, Steve, I have got to butt in here and say, folks, that is aggressive. You better know what the hell you're doing. You better have Steve's sense of discipline and his knowledge of
Yeah.
math to go 10, 20% on a position. Just so, I got to tell him that. Got to. Um, when did you, like I said, to me, that's aggressive. To our average listener, that's going to be really aggressive. How did you come by this? Were you always this aggressive? Put it that
This is tame. Yeah. Everybody think I got soft tame now. I mean, I used to. There were years I'd hold half of my retirement in a single stock and did real well during the 2003 to 2000. I mean, yeah, this is so tame to me, but
Yeah.
but I learned a lot of lessons. Like you said early on, I had the .com bubble popping taught me a lot of risk management lessons because I thought I had it all figured out in the 90s and everything changed. So that taught me a lot. But I still can't. But a lot of my aggression, though, is usually in low volatility indexes or slower moving stocks when I'm
Mm-hmm.
my aggressiveness. But I usually cut. My biggest thing is I kept my stops really short. I usually won't be down a couple percent in a stock, and I
Yep.
usually won't be down a percent or two in an index. I cut my stops really
Yeah.
short. But if I'm right, I'll make multiple times more. So that's really how tight stops is how I really manage them and getting really good entries with good risk reward ratios with tight stops.
Tight stops, strictly observed. Um, you know, with I don't know about the tight stop strictly observed, but with the big positions and the half the retirement account, I mean, you sound like Stanley Druckenmiller or somebody. You sound like one of
Yeah,
these
my,
really, you know, big
my
macro guys who place these massive levered bets. Do you still, yeah, and you still use leverage to this day?
I'll use leveraged index ETFs is about
Mhm.
all I use. I mean, but like you said, younger, 10, 15 years ago, oh my goodness, I loved going big and I was had so much luck in the 90s. It was just,
Oh yeah,
I mean, it was so easy. And even another great 2003, 2007 was another great run. But I think after the
yeah,
financial crisis, really, I did great avoiding the financial crisis losses because of my lessons
yeah,
from the .com pop.
right.
But after the financial crisis, I really cooled my jets. I mean,
Yeah, you and a lot of other folks, I'm sure. But and the fact that we went through like from just call it 2000 to 2008. I mean, that's 8 years, two big drawdowns, right? That was,
yes,
I think that um, tamed a lot of folks. I bet you're not
yes,
alone in that. And then people went nuts on the resources and got whacked by 2012 or oil in 2014. It was like holy hell, just like one crushing blow after another. So I understand that. When did you start trading? Did you start in the 90s?
I started studying compounding gain charts and I was 17 years old, and I was so hungry to get going on compounding capital when I was 18. And yeah, I started 1991 is when I started. I was about 18. I started, just a little bit of capital, a little
Mhm.
grub stake, and just started investing and growing and compounding at 18, and I got right into the 90s, which worked out great.
Yeah, that was a nice ride from 91 to, like 2000 basically. Wow, yeah, we get man, I've talked to so many people. A lot of them that I talk to are maybe like half a decade younger, and they'll say, "Yeah, I started in 95 and it was great for 5 years. And then I lost 80% and I learned all the stuff that we're talking about today." That's
Yeah,
the core conversation that I have with traders is who of that age. But it's good, isn't it? It's good to
yeah,
have those experience. Like, I mean, can you share what happened to you in the dot-com bust?
yeah. .com. I mean, I was compounding, unaudited gains, not claiming my return, not audited, but I compounded about 20% returns every year through the 90s. And I
Yep.
think I hit 40% in the 99,
Hmm.
about 45. And I was just doing like mutual funds back then. You didn't really have index ETFs. I was using mutual funds and
Yeah.
high growth tech mutual funds. I remember one of my accounts had quadrupled in a few years. It was all tech mutual funds, but I ended up, I was more of a, an investor, really hardcore investor, like sort of like the Bitcoin people, like tech is it. I thought tech was the future for the 90s. I thought
Oh
it
yeah.
makes sense. I'm
Oh
investing in
yeah.
tech, and I was doing the right thing at
Yeah.
the right time, just for almost blind chance, and
Yep.
did not really just. And then I ended up having about a 50% drawdown from my peak. I mean, but the cool thing is, even at a young age, I had about enough to pay my house off when I was about 27 years old. I didn't do it,
Oh,
but I
that's
had enough
cool.
about 27. So I thought, man, this is the life.
Yeah.
And but then I had then I mean, inflation adjusted, it was a good amount of capital. I ended up getting about a 50% drawdown from my peak. I peaked, I think it was the double top of the Nasdaq 5,000 where I didn't quite get there. That was my peak capital. And then I started aggressively moving in and out of it. I would
Hmm.
buy dumps and sell and buy deep dips. And I started trading more actively through
Hmm.
2000, 2001. Ended up being down 50% from my peak. And I bottomed out around early 2003, And then I got back on my streak again. I started doing good double digit returns, like 20 some percent a
Yeah.
year
Wow.
for through 2007. But I was a chicken, and that's when I also put half of my retirement into a single stock and it quadrupled. And so once again, I think I'm a genius. And then
Yeah.
2008, I started getting nervous, thinking something's not right here. I'm not giving this money back again.
Steve,
And I slowly
what was the
moved.
stock? What was the quadruple?
It was a company called Delhaize Group that was originally Food Lion. It was one of the fastest growing grocery chains
Of all
pre
things.
Walmart,
Yeah.
and I was a bagger for them in the early '90s, and I worked my way up to store manager in the mid '90s. So I had an inside scoop of I worked there. I had an inside scoop of the business. So
Oh,
I thought this doesn't make any sense. So I invested heavily, and I
that's
exited.
cool. I would have thought you were going to say, some bank or other or a home builder or something in that era. That's cool. That I didn't expect that. Anyway, also I wanted to say, um, Nas wasn't Nasdaq like a 70, almost 80% drawdown in the .com,
Yes,
and
yes,
minus 50 for a tech heavy guy. I mean, come on.
yeah.
That's
I remember. I remember in 2008 because I was managing my wife at the time's retirement account, and she also got the double digit return, 20% returns for the 2000s. In 2008, she was only up 5% in 2008, and I couldn't go short in that account. And my wife was
yeah.
upset that you just only got 5% this year. That's it in 2008. I'm like, everybody else is
I
down
know you made a
35.
positive return in 2008. You're a
Yep.
genius, right?
Yeah, she was. That's when I thought I would never want to manage anybody's money. That's for
Yeah.
sure.
Boy, I'll tell you, I thought, and I got a little pat on the back from our founder, Porter Stansberry, that year. He says, Dan recommended Walmart, and I think it was up like 20% that year. And what was the insurance company? Berkeley.
Oh yeah, I
Yeah,
remember that.
Berkeley was up about 6% that year, a
I remember.
financial stock, essentially. And I was
Yeah,
like,
I remember that. I
yeah,
remember the IBD 50 was turned into like Berkshire Hathaway and Dollar General stores if they were public at the time.
yeah,
I was like, what? I remember the IBD flipped from tech to consumer staples and insurance stuff in 2008. That's
yeah,
funny times.
yeah. You like IBD? You like Investors Business Daily? You still read it?
I've read How to Make Money in Stocks by William J. O'Neill. I read every edition of that book ever written. I think it's like 5 or 6 editions. I've read it and studied all those charts over and over again. One of my things I got started with really helped me find Priceline and Apple and back in was it 2000 2007 and 2012. That was a good period for me for IBD.
So you've would you say that was your number one influence, the O'Neill books?
I think I really ended up being more Paul Tudor Jones, more
Okay.
macro index trading. I think I evolved into that because the volatility of those individual stocks is what I made my money and to really
Right.
establish myself with the money. But boy, the bigger you get, the harder it is for that volatility. It's no big deal when you're
Yeah.
starting out.
Yeah. I mean, Chris Hone takes huge positions in individual stocks, and I'm like, I'd be soiling myself. I just wouldn't be able to do it, frankly. So I hear you. And I personally, any personal trading I do is, um, you know, small option positions on index funds. It's not anything big, and I'm mostly kind of a buy and hold guy. But the trading is all in for the reasons that you're talking about. The trading is all the big, sort of like SPY, TLT,
Yeah,
like that, just because of that reason. I mean, TLT was a little volatile recently in the past few years, even too. Um, but I agree that's an interesting way to go. Okay, so PTJ, that's a pretty good name. One of the original Market Wizards. I think he was in this first or second Market
yeah,
Wizards book. I don't
yeah.
remember.
I think my favorite thing about him is his lack of drawdowns, because that was
Yeah,
my thing. I've been so big for so long, it wears you out after, 15, 20 years of that. It just gets to be, and you have enough money to be financially independent. You're like, let's just keep it this way. And let's just, you'll trade the same, just trade differently. Maintaining the wealth is different than getting the wealth in a lot of cases.
I have to say there is, there's nothing like a loss here and there on a giant position size to really chasing an individual. I think too many individuals, kind of do what they call YOLOing now. There's a lot of people I think are virtually gambling in the market right now, in a variety of ways, right? But those moments, they're key, man, aren't they? Like, you got to look yourself in the eye and say, Uncle, I don't know what I'm doing, or what I'm doing is really wrong and needs to be rethought. Um, that's I guess what I'm trying to say, Steve, is don't you must agree that, like, let me put it this way: is there a more important moment in a trader's career than when they figure out that those big losses are just intolerable? I wonder if there's a more important moment.
The number one thing that determines profitability is the size of your losses. If you have huge losses,
Yes.
you will be unprofitable. All other factors don't matter. It doesn't matter your win rate. It doesn't
Yeah,
matter how big your wins are. It doesn't matter because it's how
that's
your
right.
equity curve flows. It's going to eventually blow up on you. So I think if you want to be profitable, keep your losses small. That's step number
It's
one.
It's totally counterintuitive too. I'm glad you put it that way. Your profitability determines on the size of what? Your profits? No, your losses. This is great. I hope that our listeners are taking a lot of good notes here, because Steve is like tossing you off. This is pure trading gold. This is like market wizards level gold. And we had Jack Schwager on the show, and
Oh
two or
man,
three
yeah,
yeah,
no Jack.
two or three of the wizards. You know Jack?
Yeah, me and him have corresponded a lot over the last 15 years.
Oh, did he ever ask you for a audited track record?
He did not, but John Boyk, he was going to write unknown market, well, not unknown market, unknown legend, unknown traders back in the
Mhm,
2000s, and he did ask an audited track record, and John Boyk was supposed to get together my track record from the 2000s, or was it
mhm,
the 90s back then, and
mhm.
uh, and I was supposed to be, but then the publisher wouldn't publish his unknown trading legends book back in the 90s, so that was a pretty cool. But I don't know if my size at the time wouldn't have qualified for Market Wizards. I don't even know if Plus, the problem was I've changed brokers so many times now. I would have kept all those. I would have kept all those statements had I known that would have mattered one day, but I have not kept all those statements. I only have whatever my previous broker is for the last
Right,
8 9 years.
right.
So,
And
but that's fun.
for a lot of that time, it's probably just hard copy statements through the mail, right?
Yes,
Yeah,
exactly. There was no online in the 90s. I
yeah,
remember doing a
yeah.
lot of my trades on the phone where you had to push in buttons on the phone for your percentage of your portfolio allocation.
Wow. Yeah. I think um, I think actually this is an important topic. The fact that trading has become so frictionless and easy. Absolutely anyone can throw money into an account, fill out the online form, and you're in business just like that. And I don't know. I don't know how I feel about this, honestly. I'm like, well, it is a good thing overall. I do believe it is a good thing. But, I also know it's like making gambling easier, just human nature, right? It's like making gambling easier, and that's going to create a lot of gambling addicts, right? I mean,
It's like the low barrier to entry creates the danger. I mean, they provide liquidity, which is
yeah,
good for professionals, but it's a no barrier to entry. Could you imagine if people could go practice law or practice medicine and make money on the weekend? Everybody go, oh yeah, I'll go do this court case and make $5,000. Like
right,
that's why it's so dangerous because there's no barrier to entry for trading
right.
now.
So listen, folks, write down the words low barrier to entry. Steve, why is a low barrier to entry bad? Why is that troublesome for a trader?
Yeah, like you said, they bring in the gambling mentality, and they don't have it's like just like at a casino, the casino paradigm where the casino is a business model. They know what their bet size they will allow, they know what the edge is in all their games, and they know they're going to win long term. Those big giant casinos in Las Vegas they don't just do that for charity. They got all that from people losing money to them. And the
Right,
traders come in with the gambler's paradigm where they have the odds against them. They're randomly making gambles based on predictions and opinions, so they don't have an edge right out of the gate. And the professionals are going to act like casinos and take their money through a positive expectancy they have on their own systems. And that's just, and that nobody even thinks of it. It's math. The casino
right.
paradigm, casino business model is math, and it
Yep.
applies the same way for
The
traders.
the math works in the casino's favor, not yours. Also, I would say I'm 100% confident you'll agree with me on this. Also, that low barrier to entry means the competition is everywhere and it is ferocious and it has more computers than you and it has physics PhDs working at Renaissance and it has like every tool imaginable. AI, they have like, their data centers or whatever, they're trading up like nearer to the exchange, and they actually pay money to route the signal through the wire in the shortest possible way so they can trade at the highest possible frequency, which you absolutely cannot do without tens of millions of dollars. I mean, it's just the competition is absolutely insane.
And even on top of that, Robinhood is selling your order flow. You are
Yeah, yes.
liquidity. You are liquidity for someone else to make money off of.
Yep. You're the exit. Your buy is some more informed trader's exit. Just so you know. Okay, so now that we've like beaten them down with the fact that there's no way they can compete, what do you do? Have we already really told them what you can do to get an edge back, or is there something else?
Well, the most like we talked about, the best thing you can do to start with is do not have any big losses. That is controllable. You cannot control the size of your wins, but you can control the size of your losses with stop losses and position sizing. So
Right.
start with small losses, but you have to build a systematic process. And the best way to beat a high frequency trader is be a low frequency trader where you have your own system, whatever it is that has an edge, whether it's a day trader buying a range breakout at the first 30 minutes, or if it's following swings or trends and having a quantified process where you've back tested it, you've seen how it operates historically, you understand the risk reward ratio, you understand the back tested data, you find patterns in the market that repeat, and then you trade them. And then you create a positive expectancy model out of it where you know what your expectancy is. You know you're going to lose so much, you're going to win so much over a series of trades, and you know what environments it does best in. But it's like a business. You're creating a business out of your trading where you're buying merchandise at a price and selling it for a higher price. Whether that's buying at the cheap deep dip buys, or you're buying breakouts high and sell, either buy low, sell high, or you're buy high, sell higher. But it has to be a quantified process with an edge that has a positive expectancy. And you know
Yeah.
your numbers. You know your numbers. You know what to expect from your system.
So I wonder if you can give us like a good definition for sort of a layman who's not a mathematician. Like, what do you mean by the term positive expectancy? That's a mathematical term, is it not?
Yeah, it's a formula where you see how many trades you have, and what your average loss is versus your average win. So you see what all your average losses are and what all your average wins are going to be, and does that equal a positive amount? So you see the biggest factor in that formula will be the size of your losses, and the best way to be profitable will have big wins. The best way to be unprofitable have big losses. So you want to have an expectancy, and if you are controlling your stop losses, and you know the market over time tends to trend or swing, so you know you're just trying to find a directional bias at any given time. It could be a signal. The turtle
Right.
traders, made fortunes. Well, was that in the 80s, the late 80s? The turtle traders made a fortune with simple breakout systems with commodities, because
Right.
commodities tend to have big trends, and they have much bigger trends than they do with the chop. So if you have a system for capturing those big trends, huge wins, you're going to make money over time. So their
Right.
systems was simple. Was it breaking
It's like
55-day breakout and then a
50.
sell,
Yeah.
sell if it breaks down below what a 20 whatever 30-day low or something. It's 55 breakout and then a
Hmm.
half of that low you get out, and they made a
Hmm.
fortune off of that. That was their system base, but also position sizing and volatility filters.
Yeah. 55-day breakouts. The turtle traders. Um, I don't know if we need to get into who the turtle traders. There were some of the market wizards. Really, is all you need to know. And you can Google like what's his name, Richard Dennis and William
Eckhart.
Eckhart. Thank you. Were the originals. Um, okay, yeah. So in other words, however you have traded for the past year, 2, 3, 5, 10, you've generated a certain amount of gain or loss. And if you've generated a gain over a long enough period of time, let's just say your system has demonstrated a positive expectancy, and if you've generated a loss over a long period of time, it's demonstrated a negative one, and you better get a new system. You're going to have a problem. Okay, simply put. But also, like, traders use this to look forward too, don't they? Like, you can sort of model a system for yourself and see, if it works just by plugging in what, like, different expectations for the average gain, different expectations for the stop loss you're willing to institute, and are there any? There must be other key inputs. That sounds too simple to me.
Yeah, well, volatility filters. You also need to consider the volatility of whatever you're trading and how your position size based on the stop loss. And the stop loss has to be based on on a technical level.
Mhm.
If you've seen a chart bounce off the 200-day moving average 6 times in a row, and you're going to buy right at the 200-day moving average, then your stop loss at 200-day moving average, you can have a bigger position size if your stop loss is tight. But if
Mhm.
you're trading in the middle of a wildly volatile environment, you have to lower your position size. You have to filter like an average true range. Like the average true range will show you how much your stock or your chart typically moves. So if your ATR doubles, then you want to cut your position size in half because your risk has doubled. So that
Right.
is another, and I think the turtles also use that in their commodity trading, filtering
Okay.
volatility risk.
We could get into this a little more, but Steve, I know my listener, and I know that they're like me. They're human, and they know something about finance, and they are grateful for all this talk about position sizing and other risk controls, all the emphasis we've put on controlling the risk and keeping losses small. But eventually, we all want to know, how does this guy take a trade? What does the entry look like? What are you looking for to enter the trade?
Yeah, I'm looking for positive momentum, whether that's a 5-day, 20-day EMA crossover. I found that to
Mhm.
back test very well in things that are under demand, especially indexes, leading
Exponential moving
stocks.
average, everybody. Sorry, EMA.
Yeah,
Sorry.
yeah, five
Yep.
because it moves faster, it adjusts faster with the prices. So if you back test a 5-day, 20-day EMA crossover on the daily chart on most indexes or leading stocks, they have a positive expectancy over time. During bear markets, they'll beat buy and hold. I mean, sometimes they don't quite beat buy and hold, but you can drop your drawdown in half when you actually have an exit strategy if you're trading the indexes or leading stocks. But the key is that I have to have things in demand. Like you want to be trading stuff like Nvidia or the semiconductors ETF or Apple. You want to have things with built-in demand or index, even sector index ETFs. You want to have things in demand. You don't want to be buying junk, junk off the bottom and things that have bad financials because you want to find stocks that have
And
good
yeah,
fundamentals, and then you can trade them using technicals. But you want solid fundamentals for what you trade.
yeah, another thing that we often hear, and as a firm, Stansberry, man, we I wouldn't say we pioneered it, but certainly in the newsletter business, starting in the early 2000s, like, we were focused on quality back then. We were focused on, good financials and good businesses back then. And that, of course, has become, like, many, many, many of our guests will say, yes, I trade momentum and enter trades this way and size them and all the rest of the things that you're talking about. Um, but also, like you, we wind up here saying, don't buy garbage. I mean, and it's not just don't catch the falling knives that have negative momentum, is it? Because a great business can have negative momentum, right? And you want to keep an eye on it. If you want, maybe you want to short it, maybe you want to keep an eye on it for a bottom, whatever. But you want to keep an eye on it. The company with negative or positive momentum that is a piece of garbage, that's a red flag. And so you won't trade them at all, like honest engine, Steve. Like, you won't buy, like, you know, I don't know. Um, Let me pick a decent one that had a run, like, the ARK fund, ARKK, or which was loaded with garbage. And that thing had a heck of a run up to 2021. I mean, a heck of a
Yeah.
run.
I added it to my watch list in 2021. I avoided it and I finally added it to my watch list and then it just kept stopping me out. It's like, what? Now it's garbage. And after that run up,
Yeah.
But it had some good. I mean, those stocks, even though they were like not fundamentally sound, they, like you said, they performed amazing during 2020, 2021. But the fundamentals still were not there, so it was removed pretty quickly afterwards. But they did have some good stuff in there too. And I do like ETFs with diversified ETFs. I love them because they lower the volatility and risk through the diversification. But yeah,
Mhm.
no, I don't go chase looking in dumpsters for stocks. I mean, the things that have always made done well for me are things I knew. I had an Apple iPhone. Apple did great. I use
Right.
Google every day. Google did great. They're not hidden.
Do you only trade stocks? Are you just buying and selling stocks, or do you use options as well?
I did options heavily for like 2007 through about 2013. I did
Yeah.
play options. I mean, during the good bull market years, but the volatility. Wow, I tell you what, there was one year that I ended up being down 50% in the year with options. But no, I was
Ooh.
up first. I was up 70%, then I was down 50%, and then I was back. Finished the year up 52%. Not audited. I'm just sharing my experiences, but it's like that's exhausting. I mean, it's just they're priced so perfectly. It's like the time decay and the prices are perfectly 90% of the time. Like 90% of the time, it's so hard to even overcome the theta cost of the option, or the vega cost gets priced
Yeah.
out when the volatility collapses. There's just a whole other dynamic that makes trading much more complicated. So I had a great
Yep.
run as usual. I got lucky out the gate and got lucky and did well. And then reality set in. Then I went back to equities.
Yeah. If anybody doesn't know about options and you think you want to trade them, um, type the words option Greeks into a search engine and read all those 5 or 6 or 7 things or whatever they are, those Greek words, and consider how multidimensional and complex the movement of the price of a call or put option is. Just consider that, please. Do that little exercise. I'm not saying you're going to swear off options, but you're going to understand that there's an aspect to them that is, it's a derivative. So it's a derivative of
Mm-hmm.
another instrument. So it's got a layer of complexity to it. And boy, that's a fat layer, is all I want to tell you.
And how good the option sellers are at pricing them accurately. Like even
Yeah.
especially through earnings with it, it's like the bookmakers. Like through earnings, you can almost know what's going to move just based on even if you're right on the right side of it, you can still lose money because of the Vega crush after earnings. That
Mm.
is a professional level game. I think in the money options is what I used to like to trade the most with the highest the highest delta, because you could be right and make money a lot easier. You risk more, but the in the money options is what I prefer if you're going to go the option route.
All right, there you go. This is not advice. This is, just
It's not financial advice.
we're just talking. Uh, that's cool. So let me ask you this, Steve. Um, I know not traders often don't like to tell you what's in the book at any given moment, and if you don't want to, that's cool. But can you tell us, like, what is it right now that has you excited as a trader? What trades are the most exciting looking to you right now?
This right, man. Today was a shocking turnaround, but like right now, I like the Vanguard total stock market. That is a strong. Things that aren't exposed to AI, Nvidia, and semiconductors right now have been doing.
Okay.
Apple's sort of like a consumer stock now. It just had a 5-day, 20-day EMA crossover. Silver looks promising again. It also had a 5-day, 20-day EMA crossover. So, not investment advice, but right now I'm long the Vanguard total stock market. I'm long the Dow, the DIA ETF,
Okay.
and and silver. Not investment advice, just my current positions, which could be stopped out of today or tomorrow.
That's the other thing. You're talking to a trader. It doesn't mean he's going to be in it for the rest of his life or even for the rest of the next 10 minutes. Um, that Vanguard, that's not VOO, is it? Which one is it?
VT, I think it's VTI.
VTI. Okay. All right. Just for folks to have a look to see what they think. I mean, we're not telling you to buy or sell anything. All right. Steve, I could do this for a couple hours. I'm having fun. You're a good talker. I love good talkers. But we really should ask our final question right now. And the final question is the same for every guest. It's absolutely identical. Even when I don't talk to people in finance, every now and then I'll talk to somebody who's like a health expert or something. And it's the identical final question. If you've already said the answer to it, as in our conversation, just repeat it. It's no worries. The question is simple. It's for our listeners' benefit. Can you just give them one thought, one takeaway that you'd like them to go away from this with today?
If you're an employee and you're listening to me, I think it's crucial that you turn your earned income into investment income by buying into investments. For me, what I've always done is the equity in companies. If you work for a company, you need to be owning the stock in the company if you believe in it and know what it is. You need to move from being an employee, selling your time for money, to an investor or business owner where you are buying and investing in assets. That's the only way to hedge against inflation. Inflation will just kill your earned wages, especially over the last 6 years. So that's what I would say is money is not just something you spend to have fun with and optimize your lifestyle. Your earned capital, your earned income should be converted to investment capital in any way you can do it. And that's that's how you grow wealth. And your real wealth is your net worth, not your earned income. So that's financial independence, always something I've been very passionate about. That's really what started me on my own journey into everything I've done in my life. My job, my passion wasn't to have a 40-year career. My passion was to retire as quickly as I could. And that's what I pursued. And I tell you, it's a journey well worth going through if you can sacrifice for a few years.
Excellent answer. I love that answer. That speaks straight to our mission in life. So I don't know. You don't want to be an employee, so we can't hire you. But I guess we'll have you back on the podcast to repeat it in 6 or 12 months or something. But thanks for being here, Steve. I really enjoyed talking with you.
That was a great conversation. That was just outstanding. Thank you so much for having me.
All right. You bet. Thank you. Well, that was a heck of a lot of fun. And if somebody told you that, hey, there's this episode of this podcast and they're talking about the fact that trading is math and it's a lot of fun, I know you would be highly skeptical, but you just heard it. So you know that it's true. And that's Steve Burns' book, by the way, as we mentioned. It's called Trading is Math by Steve Burns and Holly Burns. And it basically tells you all, chapter and verse, much more detail of all the things we talked about today, which is, Steve's been on this journey for 15 years and he's finally getting people to listen to the fact that trading is math and that's a very exciting, wonderful thing. He's got 1 million social media followers. I'm thrilled to have this guy on the show and to communicate this message because it is true. If you can't face up to the fact that trading is math, maybe trading is not your thing. If you can embrace it, and he makes it a lot easier to do that, then maybe you can do it and make some money at it. So really super exciting. I really enjoyed that interview with Steve. Another great interview, another great episode of the Stansberry Investor Hour. I really, truly hope you enjoyed it as much as we did.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.